Welcome to this explainer. Today we're diving straight into the core investment philosophy driving the Argent Large Cap ETF, better known by its ticker, ABIG. If you've ever wondered how active management cuts through the absolute chaos of large cap equities to find real lasting value, well, you're in exactly the right place. We're going to break down the specific mechanics, the underlying philosophy, and that unique blend of hard data and human insight Argent Capital Management uses to filter out the noise and build their highly concentrated portfolio. Let's get into it.
Here's our quick roadmap for today. First up, the power of compounding. Then we'll define what makes an enduring business, unpack the science behind their alpha model, explore the art of fundamental research, and finally, look at how they actually build the ABIG portfolio.
All right. Section 1. The power of compounding. The ultimate goal driving ABIG strategy is harnessing the sheer power of time. It sounds simple, right? But pulling it off requires insane discipline. Jed Ellerbrook Jr., one of the portfolio managers for ABIG, hit the nail on the head when he said, "The most powerful force in investing is compounding cash flows over the long term." That foundational belief hasn't wavered a bit since the firm started back in 1998. The whole idea is that through every market cycle, every geopolitical shock, compounding cash flow is your true, undeniable engine of outperformance. It's not about trying to time the market, it's about holding the right cash-generating engines for the long haul.
When you look at historical performance, you inevitably see the dips, the market corrections, and those stretches of crazy volatility. But zoom out for a second. That upward trajectory of compounding growth becomes so incredibly clear. It proves that when you invest in the right companies, time literally becomes your greatest ally. It's like a snowball rolling down a hill, just gathering momentum.
Moving on to Section 2. Defining an enduring business.
Now, how exactly do we find the companies that can actually compound over time? I mean, everyone wants compounding cash flows, but identifying the businesses capable of delivering them decade after decade, that's the tricky part. So what makes a business truly enduring? In a world of rapid technological shifts and changing consumer habits, a business absolutely has to be able to evolve. They need built-in shock absorbers to moderate the downside risk when the environment inevitably flips on them.
For a company to actually make the cut for the ABIG portfolio, it has to stand rock solid on three main pillars. Number 1, growing cash flows. We're talking highly predictable revenue streams and consistently positive free cash flow. Number 2, a durable competitive advantage. This means sustainable business models that just keep delivering above-average returns on capital and can easily adapt to market curveballs. And number 3, wise capital allocation. Basically, management needs to have an investment-grade balance sheet, limit their debt, and be completely obsessed with reinvesting in the business, buying back shares, or issuing dividends that actually create real shareholder value.
All right, Section 3, the science, alpha model.
Let's look at the methodology. How do they take a massive universe of stocks and distill it down to a highly concentrated portfolio? This is where the heavy quantitative lifting happens. It's basically a 4-step funnel. They start by screening the 1,000 largest U.S. companies by market cap, mainly checking for liquidity. Step 2. They rank those companies using their proprietary 25-factor Argent Alpha model. Step 3. They bring in bottom-up fundamental research. And Step 4. The final result. A targeted, low-turnover portfolio of just 30 to 35 high-conviction, enduring businesses.
Let's zoom in on the science part of that process, the Argent Alpha model. This is a dynamic, 25-factor quantitative beast that ranks stocks from 1 to 10 across 4 main categories. First, you've got value. Basically, is the stock rich or cheap compared to peers? They look at metrics like price to free cash flow. Next is growth. How fast are sales and cash flows actually expanding? Then quality. Checking the sheer strength of earnings and the balance sheet, using things like cash flow return on assets. And finally, stability. A company's ability to thrive when things get rocky, looking at factors like the balance sheet cash ratio. These factors are grouped together like this because they tend to correlate, which really helps the model pinpoint outperforming traits, no matter what the broader market is doing.
Which brings us to Section 4, the art, fundamental research.
Now the numbers, they only tell half the story. The science gets you a fantastic list of candidates, but it doesn't build the final portfolio. That's where the qualitative side, the art, comes in. Once the alpha model flags top-tier buy candidates, the human team steps up to do a deep, bottom-up qualitative dive. They want to understand the real industry dynamics. They assess the actual competitive resiliency of the company. And honestly, most importantly, they evaluate management stewardship. Is the leadership actually aligned with you, the shareholder? Do they have a proven track record of smart capital allocation? This human element is absolutely crucial to confirm that a company isn't just looking good on a spreadsheet, but is truly an enduring business.
Finally, Section 5, building the ABIG portfolio.
So what does this marriage of art and science actually produce out in the real world? The result is a seriously high-conviction portfolio. Remember, they started by looking at 1,000 companies, but they narrow it all the way down to hold major weightings in tech, consumer, and financial giants. Think NVIDIA, Amazon, Alphabet, Microsoft, and MasterCard. The model and the fundamental research essentially handpick these as truly enduring. It's a highly concentrated, low-turnover approach. Stocks are typically purchased at a 1 to 3% weighting initially, but they're allowed to grow up to a cap of around 8% as they compound over time.
Ultimately, the Argent team will be the first to tell you that their true edge is their time horizon. By leveraging the alpha model to filter for quality and combining that with deep fundamental research to verify durability, they position themselves to just ride the compounding power of these businesses over the long haul. They literally just tune out the short-term market noise.
We've covered a lot of ground today, exploring the deep art and science of this active ETF management approach, from that 25-factor alpha model to the 3 non-negotiable pillars of an enduring business. So I want to leave you with a critical question to chew on regarding your own long-term strategy. When you look at the holdings in your accounts right now, are they backed by rigid data and deep fundamental research? In an ever-changing world, is your portfolio actually built to endure? Thanks so much for joining me for this explainer, and keep questioning the science behind your investments.